Hello and welcome to this video on income statement primer. Here we will see that how to read, understand and analyze any income statement. First and foremost, let's learn about the nature of income statement. Income statement is a flow statement. What it means that it is created fresh for every reporting period. At the end of the financial year, its net impact, profit or loss is moved to the balance sheet and sub accounts are reset to zero. Let's quickly walk through the jargons which are relevant to income statement. First and foremost, income statement has other names such as statement of income and profit and loss statement. Income statement uses accrual method of accounting. What really it means? Revenues are reported when they are earned and expenses are charged as soon as the benefit is received by the business. That is what it means by accrual method of accounting. Let's walk through a synopsis of income statement. At the top we'll have revenue, then we will have load of expenses with various categories, and finally we will have net income, also short form is NI, or PAT, which is profit after tax, or also known as NP, which is net profit. And income statement will have footnotes to explain each and every entry of the income statement. Now let's learn the key terms which are used in income statement. First and foremost, top line. Top line is nothing but the revenue of the business, and revenue of the business in turn consists of majorly sales which are shown for the earnings done by the business by selling its products and services. And revenue also includes other income beside sales and other income because of miscellaneous activities such as some rental income or income from financial investments or by selling some miscellaneous things which is not the core activity of the business. Now counterpart of top line is bottom line, which represents the net income or the PAT or the net profit of the business. How in real world top line and bottom line will look? So top line is nothing but the total income which consists of revenue from operations, which is sales, and other income of the business. In a similar fashion, bottom line is the last item which is about profit after tax for the business. Now we will learn about various expenses. Although in the synopsis I showed that after revenue we have immediately expenses and finally we have net income. However, in the real income statement, expenses will have various categories. I have bucketed them into four major categories, starting with operating expenses, which are either of direct nature, also known as COGS, or operating expenses, which are of indirect nature, also known as SGA. The third category of expenses is special operating expenses. And finally, we have non operating expenses. Now, COGS full form is cost of goods sold. SGA full form is selling, general, and administrative expenses. You can think about it like this: cost of goods sold is the expense a business has to do to ensure that its factories or plants are running so that it can manufacture its goods which are in a finished state to be sold into the market. On the other hand, SGAs are the expenses which help the business to market and sell its products to the end consumer. For instance, Maruti manufactures its cars in the plant, so all the activities which happen in the plant to ensure that the cars are ready for shipping will come under cost of goods sold. On the other hand, all the showroom expenses of displaying the cars, employees working to ensure that they answer to all the questions of the customers and in turn they sell the final product to the end consumer, all those activities will be clubbed under SGAs, which is selling, general, and administrative expenses. So, operating expenses could be of two types: direct expenses and indirect expenses. Now, let's talk about each one of them one by one. Let's take up operating expenses, which is having two categories, direct and indirect. First, we will talk about direct or COGS. So, when I say direct expenses or COGS, what really it means for a business? It includes cost of materials consumed in manufacturing the product. For instance, for Domino's Pizza, cost of dough, cost of cheese and cost of toppings will be included in cost of materials consumed, and in turn, that is part of the cost of goods sold or direct operating expenses. In a similar fashion, it also includes purchases of stock in trade. What it means that any item which is not the core product of the business. So, for instance, for Domino's Pizza, when they sell soft drinks and ketchup, they are not manufacturing it in house. However, to sell their primary product, they are trading these products from third parties to ensure that their client has a fulfilling experience. Such products which are bought as a trading item will be recorded under purchases of stock in trade. And finally, we have changes in inventories of finished goods, stock in trade, and work in progress. So, when a business runs on day-to-day basis, it will have certain items which are work in progress or which are ready to be shipped or which are stored in the warehouse as of today. All those will get recorded under changes in inventories. So, what we learn here that in operating expenses under direct or COGS, we have three different categories which are recorded on a real income statement. One is cost of materials consumed, then purchases of stock in trade, and then finally changes in inventories of finished goods, stock in trade, and work in progress. Now let's move to the second kind of operating expenses, which is indirect or SGA. Now, under operating expenses which are indirect or SGA, we have employee benefits expenses and we have other expenses. Now, in employee benefit expenses, we will have salaries, the retirement benefits like PPF, gratuity, and all. And similarly, under other expenses, we will have advertisement expenses and maintenance expenses, etc. The third category of expenses is special operating expenses. Now, when I say special operating expenses, what really it means is that there is an expense on real income statement named as depreciation and amortization expense. Now, this needs a bit of explanation. Let's take example of Maruti again. It will do huge expenses to build the plant, keep machineries in the plant, and all those expenses are so huge that you cannot put those expenses right away on your income statement. So, accounting rules have given the leeway to the management, or they have made certain way of recording such expenses. So, the major expenses which will benefit the business year after year will be recorded as an asset and in a piecemeal manner, depending upon which accounting rule is chosen by the business according to their industry and need. Those expenses will come to income statement in a stepped manner. Such expenses are recorded as depreciation and amortization expenses. So, when I said Maruti, which is a manufacturing business, will have plants, will have machineries, they will record depreciation. On the other hand, a knowledge based industry, any IT industry or a pharma industry, will have lot of patents which we cannot touch and feel. They call them intangibles. Any expense recording on behalf of development of such intangible assets or the patents or the brand will be slowly coming to the income statement in the form of a stepped manner, and they are recorded as amortization expense. That's why I named it special operating expenses. Now, this is the long description which I just said verbally. You can pause the video and you can read it. Final expense is non-operating expenses. Now, these are two kind. One is the finance cost. Any business will have a need of money from outside parties, and in turn, it has to pay interest on those loans or working capital arrangements. And in a similar fashion, any business running in any country will pay taxes to the government on their profits. So these two, finance costs and tax expenses, will come under non-operating expenses. Now let's analyze a income statement. Income statement will typically have 7 items. It will start with revenue. It will have cost of goods sold. It will have SGAs, depreciation and amortization, interest expenses, taxes, and finally we'll be left with net income. 2 to 6, all these are expenses we discussed in the previous few moments. So all these are coming from the expenses side. Now, among these 7, 5, the middle ones are the expenses. Now, if we subtract 2 from 1, we get gross profit, also known as gross earning or gross income. Similarly, if you subtract 2 and 3 from 1, we will get operating profit, or also known as EBITDA. And when you subtract 2, 3, 4 from 1, we will get EBIT, which is earnings before interest and taxes. Here, EBITDA is earnings before interest, taxes, depreciation, and amortization. And when we subtract up to 5 from 1, we will get earnings before taxes, EBT, or we also call it pre-tax earnings. If we subtract up to 6 from 1, we get net income, also known as post-tax earnings, profit after tax, or net profit. So that is the overall analysis, that how we arrive at different kind of incomes on a income statement. Now let's walk through key ratios. There are 3 key ratios in income statement you should be aware of. First and foremost is, if you take gross profit or gross earning or gross income and you divide that by revenue, you will get gross profit margin, which is known as GPM. In a similar fashion, we have operating margin, where we will divide operating profit by revenue. And finally, we have net profit margin, where we will divide the net income or profit after tax by revenue. So with this, I conclude this video, and I hope to see you in the next video. Until then, best wishes.